Welcome back. You're watching News Now. I'm Shibani Gharat. Now, ICICI Bank is expected to report a steady set of numbers this time around the net interest income likely to jump 7% year-on-year basis. My colleague Harsh joins in with what more to expect.
When we speak about ICICI Bank, essentially it's the kind of margin beat that they've always delivered that we've gotten used to. This time around as well, the analyst community expects a 5 basis point dip in the margins. So margins, net interest margins will likely come off by 5 bips, but what we'll see is a steady growth both on the loan book as well as on the deposit book. We're seeing 4% sequential loan growth. That's what's being penciled in. 3% deposit growth is also being penciled in. One of those few private sector banks which have not come out with numbers prior to the quarter. So essentially that's one of the key numbers that we'll look out for, where the growth comes back in a sharper fashion. What we're seeing is, though, operating leverage start to play out, and 6.5% is the kind of operating profit growth that the analyst community is penciling in. Around 18,500 crores where operating profit is expected to come in at. Provisions on a sequential basis will dip sharply because, if you remember, there was that agri-related provisioning which the RBI mandated that ICICI Bank does. Now, that has come through in the last quarter. So this quarter, you likely see a taper down on a sequential basis of the provisioning sharply by 43% odd. And what we are therefore seeing is provisioning at around 1,450 odd crore. Profit after tax expected to grow, therefore, by 12% on a sequential basis, but absolutely flat on a YOY basis. That number is expected to come in around the 12,500 crore mark. So that's broadly the numbers themselves. Asset quality trends will continue to show improvement. The GNPA and NPA ratios will continue to shrink, and that margin number, which came in at 4.3%, I did speak about that, will come down to 4.25%. Now, really, a stronger deposit growth will obviously be better, and we look out for that number, both quarterly average balances as well as period end balances. ICICI discloses both. The LDR movement also is something we will track. The way forward with regard to growth and margins, what's the kind of growth penciled in for FY27 is what we look for. ROA sustainability, best-in-class ROAs is what ICICI Bank clocks. Can they continue to do that will be the question. And commentary on impact of the latest guidelines by the RBI, especially with regard to net open position in US dollars, which is restricted to $100 million. What is the impact of that in this quarter as well as the following quarter? That's something that investors will follow.
Harsh, thank you so much for getting us that roundup. Now, banking major HDFC Bank is all set to report its Q4 numbers, which is largely expected to be steady. My colleague Mitali is here to tell us more on what the street is expecting.
The largest private sector bank set to declare numbers. 33,000 crore, 33,500 crore odd is where the net interest income is expected to come in at, which is around a 3.5% sequential growth. What we've seen is a 4% growth on the advances front, or 3.8%, but that's period end. When we are seeing the overall manner in which margins are shifting, and that's the more important or the relevant metric to look at, it's going to go up by around 4 bips. So from 3.35%, that number is expected to come to 3.39% for this quarter, which is Q4 FY26. What we're seeing on the operating profit side as well is around the 2.5 to 3% lift on the operating profit number, which is expected around the 27,900 mark. Provisions will largely be benign. Credit costs will largely be aligned with how HDFC always does. So 3,300 crore odd is where the provisions number is expected in at, and 19,000 odd crore is where the profit after tax is expected at. Now, really, that's where the essence of it lies. Can there be a double-digit PAT growth FY27? Really, that's what the street will be really looking out for from HDFC. Now that the rates have settled, the merger is 3 years behind, and you've likely going to start to see credit growth pick up. You'll see plenty of levers to probably get some comfort of that. But for the moment, they'll do 8% growth for Q4 FY26 on a YOY basis. What we're also seeing is, or rather monitoring, is the fact that LDR, which is loan to deposit ratio, while period end loan to deposit ratio shrunk sharply towards the 95% mark, what we will essentially look for is that the average quarterly balances on the deposits front were not as healthy in terms of growth. So therefore, sustainability of that very strong deposit growth is really what I think the street will be focused on. And obviously, with the regulatory change around the US dollar or rather the dollar notification by the RBI, what impact will that have both in Q4 and Q1 will be a monitorable, and the impact on treasury income also will be a monitorable.
Thanks, Harsh. Now on to an ET.